Something unprecedented is happening across Europe's financial landscape. The alarm bells aren't just ringing anymore, they're screaming. Before we dive into what could be the most significant financial crisis of our generation, hit that subscribe button and comment below which European bank you think is most vulnerable. Your insights matter, and this conversation could save your financial future. The European banking sector is sitting on a powder keg, and the fuse has been lit. Deutsche Bank's stock price volatility in recent weeks has sent shockwaves through financial markets, while Credit Suisse's collapse in March 2023 wasn't an isolated incident, it was a warning shot. The subsequent acquisition by UBS didn't solve the underlying problems, it merely swept them under a very expensive rug. What we're witnessing isn't a simple correction or a temporary blip in the market cycle. The structural weaknesses that have plagued European banks since the 2008 financial crisis never truly healed. Instead, they were bandaged with quantitative easing, negative interest rates, and massive injections of liquidity from the European Central Bank. Now, as inflation forces central banks to raise rates at the fastest pace in decades, those bandages are coming off, revealing wounds that are far worse than anyone anticipated. The transition from a decade of near-zero rates to the current environment has exposed banks that became dangerously dependent on cheap money. European banks are carrying approximately €3 trillion in exposure to commercial real estate, a sector that's collapsing faster than most analysts predicted. The shift to remote work hasn't reversed, it's accelerated. Office buildings in Paris, Frankfurt, London and Milan are sitting empty, their values plummeting while the loans secured against them remain on bank balance sheets at pre-pandemic valuations. This isn't just a real estate problem, it's a ticking time bomb buried deep in the core of European banking infrastructure. The interconnectedness of European financial institutions means that when one major player stumbles, the entire system shudders. We've seen this movie before, but this time the script is darker. Italian banks alone hold over €400 billion in government debt, and with Italy's debt-to-GDP ratio hovering around 140%, any sovereign debt crisis immediately becomes a banking crisis. The feedback loop between sovereign risk and banking risk creates a vicious cycle that policymakers have struggled to break for over a decade. Germany's banking sector, once considered the bedrock of European financial stability, is showing cracks that can no longer be ignored. Regional banks, the backbone of German industry, are struggling with outdated business models and technological infrastructure that belongs in a museum. The cost-to-income ratios at many of these institutions are approaching 70%, a level that makes profitability nearly impossible in the current environment. Meanwhile, their exposure to Eastern European markets, particularly Ukraine-related loans and Russian asset write-downs, has created holes in balance sheets that official stress tests conveniently overlooked. The derivative exposure across European banks remains one of the most underreported risks in the global financial system. Deutsche Bank alone holds derivative contracts with a notional value exceeding €40 trillion, a number so large it defies comprehension. While notional value doesn't equal actual risk exposure, the complexity and opacity of these instruments mean that nobody truly understands the counterparty risks involved. When Lehman Brothers collapsed, it had roughly $600 billion in derivative exposure. The scale today is exponentially larger. French banks have their own unique vulnerabilities, particularly their massive exposure to African sovereign debt and emerging market currencies. As the CFA franc system faces increasing pressure and African nations push for monetary independence, French banks could face significant losses on what were considered safe, government-backed investments. BNP Paribas and Société Générale have built business models around these relationships, and the unwinding of decades of financial ties could trigger losses that dwarf current provisions. The European Central Bank finds itself in an impossible position. Inflation remains stubbornly high, requiring continued rate increases to maintain credibility. But each rate hike pushes weaker banks closer to the edge, threatening financial stability. The ECB's balance sheet has swollen to over 8 trillion euros through various asset purchase programs, and unwinding these positions without triggering a crisis requires a delicate touch that may no longer be possible given the inflation mandate. Christine Lagarde faces choices that have no good outcomes, only varying degrees of pain. Depositor confidence, the invisible thread that holds the banking system together, is fraying. The bank runs we witnessed at Silicon Valley Bank and Credit Suisse weren't confined to those institutions. They revealed how quickly digital banking can accelerate a crisis. Money moves at the speed of light now, and a bank that appears solid on Monday morning can be insolvent by Friday afternoon. European deposit insurance schemes, while theoretically robust, have never been tested at scale. When multiple major banks face simultaneous runs, the question isn't whether the insurance funds can cover deposits. It's whether governments can print money fast enough to maintain the fiction of safety. The commercial real estate crisis deserves deeper examination because it's not just about empty offices. Retail spaces across Europe are being hollowed out by e-commerce, a trend that COVID accelerated but didn't create. Shopping centres that were valued at hundreds of millions of euros now struggle to find buyers at any price. Hotels in tourist-dependent economies loaded up on debt during the boom years, and many will never generate sufficient cash flow to service those obligations. The loans backing these properties are scattered across European bank balance sheets like landmines, waiting to explode. Regulatory capital ratios, the numbers that are supposed to tell us how safe banks are, have become increasingly divorced from reality. Banks have become masters at gaming these metrics using risk-weighted asset calculations that classify obviously risky loans as safe. A commercial real estate loan in a dying shopping mall might carry the same risk weighting as a government bond, despite the obvious difference in actual risk. The Basel III framework, implemented to prevent another 2008, has been watered down through lobbying and compromise until it barely constrains the most aggressive behaviors. The political dimension of this crisis cannot be ignored. Banking failures in Europe aren't just economic events, they're political earthquakes. The rise of populist movements across the continent has been fueled partly by resentment over bank bailouts and austerity measures implemented after the last crisis. Italian, Spanish, and Greek voters haven't forgotten who paid the price when banks failed. Any large-scale bailout in the current political environment could trigger social unrest that makes the yellow vest protests look mild by comparison. Pension funds across Europe have become unwitting participants in this crisis. Desperate for yield in a low-rate environment, pension managers loaded up on riskier assets, including bank bonds and structured products that carry far more risk than their credit ratings suggest. When major European banks start failing, the pension crisis that's been building for decades will explode into public consciousness. Retirees expecting stable income will find their payments cut, creating a social crisis alongside the financial one. The energy crisis triggered by Russia's invasion of Ukraine has added another layer of vulnerability to European banks. Energy-intensive industries across the continent face existential threats from high natural gas and electricity prices. The loans extended to these industries, steel mills, chemical plants, manufacturers, are increasingly at risk of default. Banks with heavy exposure to industrial lending in Germany, Italy, and Eastern Europe face losses that weren't contemplated in any stress test conducted before the energy crisis began. Corporate debt levels across Europe have reached historic highs, sustained by years of cheap borrowing. As rates rise and refinancing becomes expensive or impossible, we're entering a wave of corporate defaults that will peak sometime in late 2024 and into 2025. European banks are the primary lenders to these corporations, and the loss provisions required will devastate earnings and capital ratios. The zombie companies kept alive by cheap money are finally dying, and they're taking chunks of bank balance sheets with them. The comparison to 2008 understates the current danger because the policy tools used to fight that crisis have been exhausted. Interest rates can't be cut, they're already being raised to fight inflation. Quantitative easing on the scale needed to stabilize failing banks would destroy currency credibility and accelerate inflation. Fiscal space for bailouts is constrained by debt levels that have exploded since the last crisis. Europe enters this potential banking crisis with an empty toolkit and a public that won't tolerate another massive transfer of wealth from taxpayers to bankers. What makes this situation particularly treacherous is the timing. A banking crisis during an economic expansion is manageable. Governments have revenue, unemployment is low, and confidence is high. A banking crisis during a recession or stagflationary environment creates a doom loop where each problem amplifies the others. Europe teeters on the edge of recession while inflation remains elevated, the worst possible combination for managing financial instability. The contagion mechanisms today are faster and more complex than in any previous crisis. High-frequency trading algorithms can trigger cascading failures across markets in microseconds. Social media amplifies rumors and accelerates bank runs. The interconnection of global financial markets means that a crisis beginning in Europe won't stay contained. It will spread to every corner of the global financial system within hours. Your comment about which bank seems most vulnerable isn't just an academic exercise. It's a question that could determine the trajectory of the global economy for the next decade. Subscribe now, because what happens next will define financial markets for a generation. Use a clear male voice. For the narrator, use appropriate media. Make 7 seconds for each media in all video, and don't repeat the same videos.